Hey, this is Thomas. The Canada Pension Plan, or CPP, is one of the primary income sources that people rely on for income. So it makes sense that some of the most common questions I get around for retirement is have to do with CPP. Should I take out the CPP early at age 60? Or should I wait until 65, which is the common age? Or should I even wait until 70 so that I can get a larger payout? So in this video, I'll be talking about when is the best time to take out your Canada Pension Plan for maximum benefit because the answer might surprise you. First, let's do a quick recap of what the Canada Pension Plan is. I talk about CPP in my other videos, so for a more in-depth look, please check out those videos. CPP is a monthly taxable benefit deducted from your salary by the Canadian government that is designed to replace part of your income when you retire. You can kind of think it as a kind of forced saving account that government sets it up for you. Now, if you're an employee, each year, both you and your employer will each contribute $3,500 to your CPP program. If you are self-employed, then you need to contribute both the portion, which is $7,000 from your pocket, into the program. The amount you get in CPP is going to depend on how many years you have worked in Canada and how much your annual salary is. Now, up until April 2022, the average CPP payout at age 65 is around $728 per month. The Canadian government website has a free retirement calculator that you can use to calculate how much CPP you'll receive when retired. Keep in mind that your CPP doesn't just automatically show up in your bank account. You will usually receive a letter around age of 59 or 64 to give you an update. Then you can follow the instruction for the application. Also, if you're age 65 and above and still working, you have the option of not contributing into the CPP. CPP only counts your best 39 years of the contribution in your career. Alright, now let's get into when is the best time to take out your CPP. If you wish to take your CPP before your 65th birthday for every month that you start early, you will get 0.6% less. Say if you take your CPP in one full year earlier at 64, you're going to get 7.2% less, which means if you start at age 60, you will get 36% less. For easy math purpose, let's say your CPP is supposed to be $1,000 per month at age 65. However, if you start early at age 60, you'll receive around $640. It sounds a lot less, but hey, don't forget, you get it 5 years earlier. So we'll do a comparison later on. Now on the flip side, if you were to start at any month after a 65th birthday, you would get 0.7% bonus for every month. Again, let's say if you take your CPP out at age of 66, then you receive an 8.4% increase. This also means if your CPP is delayed to 70, you will get a 42% more, which would be $1,420. This is a 42% guarantee. It's pretty hard to find a 42% guarantee increase in this economy. So in what scenario does taking CPP early make sense or delay it until later dates? The first thing and the most important thing you should ask yourself is, what is your actual retirement income and whether you need the CPP to start immediately or you can live comfortably without it. If your initial answer is yes, you might consider getting CPP early right now. Also, what is your current debt and expense? Can you use the early CPP payments to pay off the mortgage faster, help with your rent payment, or clear some of the debts? Especially in our generation, even with the age 60, not only we have to still pay for the mortgage, car, family expense, we also have to pay for our kids' education, or maybe even for our parents' medical bills. So having CPP benefits earlier, not only able to pay off the debts faster, but also can act as a reserve so you have more liquidity in your saving. Now, a quick comparison. If you look at this chart, we can see that the break-even age of a CPP taken at age 60 is 74. That means if you start withdrawing at age 60 years old, you're still ahead of the game before you reach age 74. And if you invest the money instead of spending it, you can even delay the break-even age. A further spin on that is, because CPP is a taxable benefit, what if I decide to take out the CPP earlier and put it into the RSP? And since RSP can reduce taxable income, they will simply cancel each other out. You might ask, why bother doing it? Because this has to do with the next point. The second thing you should be considering is your health and life expectancy. According to Statistics Canada, the average life expectancy for a man is 85 years old and for a woman is 87. So using the previous example, if your current health is poor, like you're a heavy drinker or smoker, or if your family has a history of heart problems and don't live long lives, then maybe taking CPP out early is better so you can enjoy the benefits earlier. Because the worst part for CPP is when you pass away, your spouse gets very little of your CPP or even close to none. Or on the other hand, if you're the remaining spouse, once you pass away, the government will not pay out the rest of your CPP to your family. And that's why sometimes it's a good idea to put into the RSP first. At least that money can definitely give it to your beneficiary instead of the government. Alright, let's talk about what scenario should I take it out later at age 70 then. For obvious reason, when you don't need the CPP benefits in a rush. And in the meantime, you are not an investment savvy person. Because with the current market volatility, each year, if we delay CPP, you get an 8.4% guaranteed return. And that's better than a lot of investment nowadays. Next reason is more complicated and require a little bit more of math work. And that is how many and how much your taxable income will be during between the age of 60 to age of 70. For example, most people nowadays are still working in their 60s, so employment income is 100% taxable, and there could be rental income, which is another 100% taxable income. What if they decide to take out their RSP or pension out early because they don't want to get taxed later? So with the $1,000 CPP payouts, it can be easily taxed at 25% to even 40% if they have the above income. Tax is one issue, and let's not forget at age 65, we can also qualify for old age security, which could trigger a clawback. OAS clawback means that government asking you to pay some of the money back to them if your personal income is more than $80,000 per year. Or some people did the retirement planning well enough, they only have non-taxable income, like having $1 million in their tax-free saving account. Because it's not considered as income, they can even be qualified for the GIS, Guaranteed Income Supplement, which is additional money. Therefore, certain people might decide to delay the CPP, collect the OAS and GIS between the 65 to 70, then start taking out CPP to maximize the income. Hey, you might think this is unfair, but this can be done with proper planning. So again, this is why it's always good to do some retirement projection just so you have an idea what your clawback will likely be if there's any. But let's not forget, say you're able to take out $1,400 instead of $1,000 at age 70, if you pass away at age 75, all the CPP is going back to the government. So here you really have to ask, what is your plan from now all the way until retirement and what you'd like to accomplish? Do you want to spend more time with family or do you want to sail the world? What is on your retirement list? These are the questions only you can answer and will help you decide when you need the money the most. The next thing on the list is how many additional streams of income do you have to supplement your CPP? The most common streams of revenue are your active income, business dividend, savings like RSP, tax-free saving, pensions, stocks, and rental income are just some of the examples. You should know all the income streams and which one you want to prioritize and which one you want to delay before you consider your CPP payments. So to wrap it up, I want to throw you a scenario, so please leave your answer in the comment box below. Let's say you're in a contest and you're at the last stage. You are given two choices, where A is you get $10,000 and you can walk out with that money, or B, you can double it or nothing. So my question to you is, would you rather take a guaranteed $10,000 or 50-50 chance at $20,000? Remember, there's absolutely no right or wrong answer. I just want to hear it from you. Alright, thanks so much for watching. This is Thomas. Thanks for spending the time with me, and I will see you in the next video.